Just I have been a student of finance for over 5 decades, and I was brought up on the rational model of finance, also called the standard model of finance or neoclassical model of finance. And in the last 50 years, I realized gradually that the rational model or the standard model has certain weaknesses which have been pointed out by people in the field of behavioral finance. Incidentally, behavioral finance was considered as an oddity, and people in rational finance dismissed behavioral finance for quite some time. I was particularly interested in this field when I read the pioneering works of Daniel Kahneman and Amos Tversky in 1979.
I think there is some.
There has some network issue, yeah.
Yeah.
It'll come back. I think you can perhaps advise him to go to a different data source. That will help. So if he can switch to a telephone network, that would be easier perhaps.
Thank you. He's trying to connect through another system. So hold on for a minute till the time Professor Prasanna Chandra joins. For the benefit of all those who have joined for this seminar, I may inform that please visit our BMA website. We have very interesting videos of all our programs that we have conducted over last complete 1 year and beyond that also. You can visit, you can listen to the interesting videos of many renowned personalities, and also try and see how the next programs that are also coming up. Today we are on 9th of June, where Professor Prasanna Chandra is addressing. On 11th, we have another very interesting session by Gaurang Das Prabhu, and the details of that also are on our website. On 18th, from 6:30 onwards, we have.
Yeah, now he's coming back.
Yeah.
Am I audible now?
Yes, you are, sir.
Okay.
Hello.
We can hear him, but yeah, lovely. Your presentation is back up, sir.
Yeah, but you may please complete your whatever you're saying.
So on 18th, we have Kevin Keller. He will be talking on art and science of branding. So request all the participants today to join on 18th also for Professor Kevin's class, master class. So thank you. Thank you. Prasanna Chandra sir, over to you.
Okay. Should I start from the beginning or?
No. Wherever you left off, we heard all the beginning part. Yeah.
Okay. So I was saying about the development that I've seen in the field of finance and the rise of behavioral finance. And when Daniel Kahneman got Nobel Prize in economics for his contributions in cognitive psychology, I decided to focus more in this area. And in the last 20 years, a lot of important financial economists have done work, and we have Nobel laureates like Richard Thaler and Robert Shiller, who got their Nobel Prize primarily for their work in the area of behavioral economics. That is the broad canvas that I wanted to cover today, to show what has happened in the field of finance, discuss some of the central ideas. It's a very, very vast field. Let me try and cover the basic ideas as succinctly as I can. As I see, the three strands of finance: quantitative finance, behavioral finance, and neurofinance. Quantitative finance or standard finance dominated the field of finance from 1960s onwards, when Met and Miller and others started the field of quantitative finance. Even today, the investment management profession is anchored in quantitative finance, a very fascinating book which captures the evolution of quantitative finance is by Peter Bernstein, Capital Ideas. Behavioral finance, as I mentioned, began receiving attention in the last 20, 25 years, and a major contributor to the field is Richard Thaler, whose book on misbehaving is immensely popular. He's also a Nobel Prize winner. And now we are seeing the beginnings of neurofinance, which is taking finance in a very different direction. I don't think I'll have time to get into that topic, but I'll briefly mention what is happening there. If I have to put it very, very briefly, behavioral finance is nothing but rational finance plus psychology, sociology, and neurosciences. I got so interested in the field that I decided to write a book on behavioral finance. The only way I learn is by teaching and writing. So whenever someone says that he has benefited from my book, I say I have benefited more from writing the book because I have learned by teaching and writing, and I decided to learn more about the field, and the best way to do was to teach a course at Bangalore and write a book. This is a book that I will be referring to during the course of my talk. Before I get into some of the key ideas of behavioral finance, let us compare rational finance with behavioral finance. The rational finance, the standard finance model, assumes that people form beliefs correctly, people are framed independent, people have only utilitarian wants, people are guided by reason and logic and have independent judgments, and the market price of a security reflects intrinsic value. Behavioral finance challenges all these assumptions. In the behavioral finance model, we start with the assumption that people often form beliefs incorrectly. People are frame dependent. People have utilitarian wants, expressive wants, and emotional wants. Emotional and herd instincts play a very important role in decision making. Often there's a discrepancy between market price and intrinsic value. In theory, investors have well-defined goals. In practice, investors are not sure about their goals. In theory, investors carefully weigh the odds of success and failure. In practice, investors often act impulsively. In theory, investors know how much risk they are comfortable with. The risk tolerance of investors varies widely with market conditions. So you find that there's a deep divide between theory and practice. I have like this phrase called homo mistakes. You know, the rational finance model assumes that we are homo sapiens, but we are homo mistakes. We make mistakes all the time. History is replete with bad choices that individuals have, nations have made. In the past few decades, a new science has emerged which shows why we are irrational, and more importantly, why we are predictably irrational. There's a fascinating book written by Dan Ariely called Predictably Irrational. I'll share with you some of my experiences with investor irrationality in the last 30 years or so. This was 1992. I was attending a board meeting of an asset management company of UTI in Mumbai. And when the meeting was on, a fund manager walked in the room and said, Saab, laddu khaiye, laddu khaiye. I said, what happened? He said, we have gathered 4,000 crore rupees or so in a single scheme called Master Gain Scheme. Earlier, UTI had great difficulty in gathering 100, 200, 300 crores, but thanks to the buoyancy in the market in 91, 92, investors flocked to this scheme and poured in nearly 4,000 crore rupees. And my response was, you should not celebrate this collection. It is extremely difficult to manage such a large pool of funds, particularly when the P of the market at that time was over 45. And the scheme turned out to be a very, very poor performer in the subsequent decade. In 2003, market P was barely 13, and the mutual fund industry collectively gathered only 100 crore rupees because investors were disenchanted. In 2008, when the market P was over 25, mutual funds gathered over 50,000 crores. What do we find when we look at these experiences? Investors go by just one number, the return earned in the last 3 to 5 years. Investors chase returns. They simply extrapolate their immediate past experience. In the last 25, 30 years, I find whatever investments have been made by the majority of investors, whether it was stocks, gold, or bond, have turned out to be lousy. There's a very interesting study done by Dr. Shankar De and others of Indian School of Business, where they looked at the daily trading volume of 1 million retail investors from January 2005 to June 2006, in which they examined 1.4 billion trades involving 37 lakh crores. And they found that retail investors consistently chase a zero return or negative return when they decide for themselves. And this was over the period January 2005 to June 2006, which was an extremely buoyant period for the Indian equity market. As the legendary Benjamin Graham said, the investor's chief enemy, even his worst enemy, is likely to be himself. Again, look at what happened to the average investor in the Magellan Fund run by the legendary Peter Lynch. During 1977-1990, when he ran the fund, he delivered an annualized return of 29%, whereas the S&P 500 produced an annualized return of only 15.5%. But the average Magellan investor realized a meager return of less than 5%, and many actually lost money. And this is because investors poured in money in the fund when it had performed very well and exited when there was lackluster performance. There is that famous story of Isaac Newton, who lost his fortune in the South Sea bubble. Some of you may know that South Sea Corporation was granted monopoly rights by the British Crown to trade with Latin American countries, and there was a lot of excitement about this stock. And Isaac Newton, besides being the brightest scientist of the era, was also the master of mint. So he was not financially naive. Master of mint in those days meant the Chancellor of Exchequer. And in 1720, in February, he bought this company stock at 100 pounds a share. He was very fortunate to buy it at 100 pounds, and he saw the stock rise to 300 within 3 months, and he sold his entire position. Then he saw the stock rise further, and go up to 700. He could not contain his envy for his friends who were making a lot of money. So he jumped to the market, investing a very substantial portion of his fortune, and then it moved up a bit and suddenly it started collapsing. Finally, he unwound his entire position and lost almost his entire fortune. As Newton admitted, I can calculate the movements of heavenly bodies, but not understand the movement of stock prices. Buffett commented very beautifully, if Sir Isaac Newton had not been traumatized by the losses, he would discover the fourth law of motion. Returns diminish as motion increases. Again, a celebrated economist, Irving Fisher, became bankrupt in 1930. We have a more recent example, long-term capital market, capital management collapse, an institution set up by the brightest minds in the finance world, including 2 Nobel laureates. Amos Tversky, who was in the economics psychology department of Stanford University, used to say, my colleagues in economics department study artificial intelligence, whereas we in psychology department study natural stupidity. Let me give you the principal models of rational finance and their counterpart in behavioral finance. My discussion may be a little academic at times because I know a lot of you are from academic institutions. The central models of rational finance are expected utility theory. The counterpart to expected utility theory in behavioral finance is called prospect theory. Mean variance portfolio theory, developed by Harry Markowitz, is a cornerstone of rational finance. The counterpart in behavioral finance is behavioral portfolio theory. Capital asset pricing model, developed by William Sharpe, is a very important foundation of rational finance. William Sharpe also got Nobel Prize in economics. Behavioral asset pricing model is the counterpart of capital asset pricing model in the world of behavioral finance. Efficient markets hypothesis, developed by Eugene Fama and others, is a very important foundation of rational finance. Eugene Fama got Nobel Prize for this contribution. The counterpart here is behavioral efficient markets hypothesis. Standard life cycle theory, developed by Franco Modigliani, another Nobel laureate in economics, is a very central theory of rational finance. The counterpart in behavioral finance, a behavioral life cycle theory. Auction pricing model, developed by Robert Merton and others, is considered as the most important contribution in quantitative finance. And Robert Merton got Nobel Prize in economics for this contribution. And we have the behavioral counterpart, behavioral auction pricing model. I am talking about this because I had the wonderful opportunity of interviewing Robert Merton, Franco Modigliani, William Sharpe, Harry Markowitz, and others. So I was convinced about the rational finance model till I started looking at the work of Kahneman and others. And now, as I said, behavioral finance enriches rational finance with insights from behavioral sciences. Kahneman got Nobel Prize in economics for having integrated insights from psychological research into economic science, especially concerning human judgment and decision making under uncertainty. I'm sure most of you would have read this book, Thinking Fast and Slow. This is a seminal work, and if you've not read it, get a copy and read it. This will be a great learning for you. Another, it's an international bestseller. The second book that I strongly recommend to my students is Irrational Exhibit, written by Robert Shiller, another Nobel Prize winner who challenged the efficient market hypothesis. I already mentioned about Richard Taylor, who wrote this work called Misbehaving. For those who are interested in understanding the basics of neuroeconomics, here is an excellent read, Your Money and Your Brain by Jason Zweig, and another book titled Inside the Investor's Brain by Richard Peterson. For those who are interested in the subject more, this is a fascinating book by Michael Gertis. And the book that I currently am looking at very keenly is Adaptive Markets by Andrew Lowe. I've given, of course, to top this list, you have this recent contribution by Daniel Kahneman Noyes that talks about another source of error in human judgment and decision making. So it's a very rich field, and I'm sure some of you would be interested in pursuing these books. Why are we hardwired for financial failure? Why are we so messed up? Forget blaming our parents. Instead, we should probably blame our great grandparents, our hunter-gatherer ancestors. We lived almost 99.2% of our existence in that phase. So our brains have been sculpted for that environment. Our brains are well designed to the environment we faced 150,000 years ago, the African savanna, but potentially poorly suited for the industrial age which began nearly 300 years ago and even more ill-suited for information age in which we currently live. And there is a mismatch between our brain and our environment. There's a popular model of the brain called the Triune model of brain, which says that the brain may be divided into three parts: the reptilian brain, the mammalian brain, and the hominid brain. The reptilian brain, also called the brain stem, is the oldest part of the brain, and it is that part of the brain which controls respiration, digestion, heartbeat, so on and so forth. It is a part of brain which is fully developed. It functions automatically. You don't have to do anything. The limbic brain, called the mammalian brain or the emotional brain, is in version 5. It has evolved over tens of thousands of cycles. That is why our emotional brain is far, far, far more developed than our rational brain. The neocortex brain, called the hominid brain or the rational brain, is in version 1. And that is why I find that people are driven largely by emotions, not reason, because the emotional brain is a highly evolved part of our brain, whereas the rational brain is a more recent addition to our brain. There's a myth that the brain is a paragon of design. David Linden, a very eminent neuroscientist, in his book, The Accidental Mind, says the brain is not an optimized general purpose problem solving machine, but rather a weird agglomeration of ad hoc solutions that have been piled on through millions of years. So if I look at the situation, we have a very bad design in terms of a brain which is ill-suited for the environment in which we live. So we make bad decisions, and these decisions lead to bad outcomes. If we look at the key contribution of Kahneman and others, they say there are two systems at work in the human brain. System 1 and system 2. System 1 is fast, effortless, automatic, instinctive, associative, and difficult to control or modify. And system 2 is slow, serial, effortful, deliberately controlled, and rational. We operate most of the time using system 1, and that is why most of our decisions are based on instincts. System 1 is fast, unconscious, automatic. Everyday decisions are made by system 1. In a typical day, you would probably make 30, 40,000 decisions. If I move my finger, I'm making a decision. If I'm raising my hand, I'm making a decision. If I'm shaking my legs, I'm making a decision. We make decisions all the time. Typically, human beings make 30,000 decisions or so in a day, and most of the decisions are guided by system 1. System 2 is slow, conscious, effortful, complex. Decisions involve system 2. System 2 is far more reliable than system 1, which is error prone. Kahneman and others started the heuristics and biases work in the field of cognitive psychology, and they found that human beings resort to a number of heuristics. These are extremely well developed, and that they are part of system 1. And these heuristics often lead to biases in many situations. These heuristics serve us very well in many situations, but often they lead to biases, particularly in the realm of finance and investment. A lot of work is being done in this area in the last 40, 45 years, and they have identified nearly 196 biases, and I'm sure in the next 15, 20 years, they will identify another 100 biases. They have been classified broadly into these areas. I will not have the time to discuss these biases in great detail. My focus will be on some of the most important biases that I see, particularly in the realm of finance. I would like to use this acronym MIRRORS to reflect some of the important biases that influence our decision making, particularly in the world of finance. M stands for myopic loss aversion. We are myopic or short-sighted. We don't look at the long-term implications of a decision. We have loss aversion. We are extremely averse to losses. We feel losses 2.5 times more intensely than we feel gains of an equivalent size. In I stands for integration. We are social creatures. We would like to behave the way others are behaving. We are influenced by herd mentality. R stands for recency. Our future forecasts are largely based on what we have experienced in the recent past. We tend to extrapolate our recent experience onto future. R is risk perception. Our risk perception is very, very unstable, and we have a very poor ability to deal with risk and uncertainty. I often say man is a deterministic animal in a probabilistic world. I repeat, man is a deterministic animal in a probabilistic world. We live in a world of risk and uncertainty. We live in a probabilistic world, but often we act in a deterministic manner, and that causes a lot of errors in our decision making. O stands for overconfidence. We overestimate our abilities, and a lot of decisions are influenced by this psychological tendency. R stands for results. We are guided by results and outcomes. We don't look at the process. And finally, S stands for stories. We are captivated by stories, but we are put off by statistics. I want to emphasize the important of stories. Why are we so bad at statistical thinking? Because we are human beings, and as human beings, we react to stories. Your mother told you stories, and you tell stories to your children. Story is the currency in which we communicate with each other. Stories connect. A well-told story connects with the listeners much more than numbers. All parts of human brain of the listener are lighted up when he or she listens to a story, but when you present facts and statistics, only one or two portions of brains light up. Stories get remembered, stories spur action, and I know how powerful stories are. Even now, my students from 1970s, when they meet me, tell me, sir, you narrated that story. They've forgotten the finance theory that I've taught them, but they remember the story because stories are very, very sticky in our brains. A very interesting book titled Human by neurologist Michael Gazzaniga says that the right hemisphere of the brain just records facts. It is responsible for the who, what, when, and where of reality. The left hemisphere of the brain interprets how and why by constructing a narrative or a story for which it has a natural fascia. That is why you find that even with meager information, people construct a story which appears plausible and believe in those stories and act on those stories. Let me summarize these weaknesses. Myopic loss aversion, we are more sensitive to loss and gains, and overly influenced by short-term considerations. Integration, we seek to conform to group behavior and prevailing norm. Our recency, we overweight the importance of recent events. Risk perception, we are poor at assessing risk and gauging probabilities. Overconfidence, we overestimate our own abilities. Our results, we focus on outcomes. The results are decisions when assessing their quality. Stories, we are often persuaded by captivating stories. The most seminal ideas of behavioral finance are prospect theory developed by Kahneman and others, mental accounting proposed by Richard Thaler, market inefficiency suggested by Robert Schiller, varied wants developed by Meir Statman. Incidentally, these three have already got a Nobel Prize, and Statman probably is a candidate for Nobel Prize in the years to come. Let me briefly tell the key difference between expected utility theory and prospect theory. Expected utility theory is a cornerstone of rational finance, and prospect theory is the central pillar of behavioral finance. The utility function under expected utility theory is shown here. Money or wealth has diminishing utility, so utility function has a shape like this. It is concave. In prospect theory, utility is not a function of total wealth. In expected utility theory, utility is a function of total wealth. In prospect theory, utility is a function of gain or loss in relation to a reference point. This is a very important distinction. For example, irrespective of the level of wealth of an individual, he or she evaluates gains or losses in relation to existing wealth. Suppose a person has 1 million rupees and he gains 100 rupees and he loses 100 rupees. Then 1 million becomes a reference point. Suppose another person has 1 billion rupees, then 1 billion rupees becomes the reference point. And gains and losses are evaluated in relation to the existing wealth. In the expected utility theory, for a person who has 1 million or 100 million, a gain of 100 or a loss of 100 will be completely irrelevant. But under prospect theory, since people evaluate gains and losses relative to a reference point, they are concerned about losses more than they are concerned about gains. As this diagram shows, people have diminishing utility for gain and diminishing disutility for losses. In the gains region, the function is concave. In the losses region, the function is convex. So they have diminishing utility for gains and diminishing disutility for losses. However, the function here is steeply sloped. Now, this is a very important figure because it represents the cumulative experience of hundreds of experiments that have been carried out. Now you find that a gain of 100 brings in a positive utility of 200, but a loss of 100 entails a negative utility of 50, which is a factor of 2.5 times. The key tenets of prospect theory are reference dependent, diminishing sensitivity, loss aversion, changes in risk attitude. We tend to be risk averse in the gain region and risk loving in the loss region and decision weights. Without getting into technicalities, let me highlight the key insights. We experience life in terms of changes. We feel diminishing sensitivity to both gains and losses. We are risk averse in the gain region and risk loving in the loss region. Losses sting us more than equivalently sized gains feel good. Decision weights are different from objective probability. Mental accounting is a very important contribution. It was suggested by Richard Thaler, who got Nobel Prize in 2017. In traditional finance, it was believed that wealth was fungible. What mattered was the overall wealth of an individual, but Richard Thaler challenged this assumption. Traditional finance assumed that every decision is based on effects on overall wealth position, as we saw in the expected utility theory. In reality, we don't evaluate every decision in terms of overall wealth. As a practical experience, people separate money into different mental accounts and treat 1 rupee in one account differently from 1 rupee in another account. Market inefficiency. Here, I would like to cite the contributions of 3 persons who shared Nobel Prize in 2013. As I said, Eugene Fama is the principal architect of efficient markets hypothesis. According to him, markets are efficient and asset prices correctly reflect available information. Robert Schiller challenged this idea and he said asset prices are far too volatile for markets to be efficient and feature rational expectation. Hansen developed statistical and theoretical tools that brought greater rigor to the study of asset prices over time. Incidentally, Farmer and Schiller, when they were given this award, a friend of mine asked me, how is it that two persons standing at two opposite ends of a spectrum have been given Nobel Prize in economics at the same time? And I narrated to him a story. There's a story of a rabbi who was sitting with a friend. A rabbi, as you may know, is a lay person in the Jewish community who gives sermons and also adjudicates disputes among members of the community. So a warring couple went to a rabbi, and the rabbi said he will first talk to the husband and then talk to the wife. He called the husband in, listened to a story. After listening to a story, he said, "You're right." Then he sent the husband out, called the wife in, and said to him, "Tell me, what is your story?" The wife told her story. After listening to her story patiently, he said, "You are right," and sent the wife out. The friend who was sitting with the rabbi said, "How can both of them be right?" The rabbi turned to his friend and said, "You are right." Essentially, the rabbi was saying, was acting like the Nobel Prize committee. The book that I referred to is Irrational Exhibit by Robert Schiller. Varied Wants. This is a very fascinating book, Finance for Normal People by Meir Statman. Rational finance assumes that we are guided only by utilitarian wants. We ask only a very simple question: what does it do to my pocketbook? Behavioral finance assumes that people have varied wants, utilitarian wants, expressive wants. What does this action tell about me? If I am playing in the derivatives market, I want to express to the world at large that I am able to control my risk even in the derivatives field. So my trade expresses something about me. Emotional wants. What emotions does it satisfy? If someone is buying an insurance policy, the need for security is fulfilled or satisfied. So we are guided by different wants, utilitarian wants, expressive wants, and emotional wants, and not just utilitarian wants as a rational finance model assumes. So let me sum up the 10 key ideas of behavioral finance: the triune model of human brain, the two systems of thinking, system 1 and system 2, cognitive shortcuts and errors, emotional shortcuts and errors, varied wants, prospect theory, mental accounting, social influences, bounded rationality in financial markets, mismatch between our brains and the environment in which we live. Another fascinating book is by Kahneman and two others. It was published recently. I just finished reading the book, Noise, A Flaw in Human Judgment. There are two kinds of errors we tend to make. We are prone to all kinds of biases which lead to a systematic deviation or departure from reality. Further, our decisions are characterized by noise, which means there's a lot of random scatter. Let me illustrate the difference between bias and noise with the help of a diagram like this. Suppose there are 4 teams of players, team A, team B, team C, team D, and they are asked to shoot. As far as team A is concerned, all the members are able to hit the bull's eye. So there is no bias, there is no noise. As far as team B is concerned, all the members are characterized by bias. They deviate systematically from the target and they are clustered together. As far as team C is concerned, it is unbiased but noisy. There is no pattern to their bias, and but there is a lot of scatter. Team D is both biased and noisy. Kahneman and others argue that both biases and noise characterize human judgment and decision making and impair rationality in many ways. Now, what are the things that we need to do? We have to acknowledge that we are prone to biases and error, and we have to develop a philosophy which guards us against these biases and error. These are some of the guidelines that have served me very well, and I'm sure all of you will find them very, very useful. Focus on the big picture. As we all know, the big picture is your asset allocation mix. That is where you have to spend the most of your time when you are managing a portfolio. What should be the proportion of stocks? What should be the proportion of bonds? What should be the proportion of cash in your portfolio? This is the most important decision, but people are obsessed with market timing and security selection. These decisions do not contribute to success in the long run. Rely on words and numbers, not sights and sounds. Words and numbers invoke the reflective brain. Sights and sounds invoke the reflexive or reactive brain. Unfortunately, today people rely mostly on sights and sounds. They are watching a television or watching something on their mobile with sights and sounds. And when you're exposed to sights and sound, your reflexive brain is activated. Look at what Warren Buffett does. He doesn't have a computer screen. He doesn't have any screen which shouts at him. He reads quietly for 5 to 6 hours, the annual reports and other documents. He relies entirely on words and numbers. So he is a model of rationality or epitome of rationality. Follow a set of quantitative criteria. You have to define your criteria as basic filters. Diversification is the most important principle in finance, and diversification is the only free lunch available in finance. Do not forecast prices. Stock prices are inherently non-forecastable. Control your investment environment. The best way to manage your portfolio is to remain insulated from the market. Only look at your portfolio perhaps once in a month or once in 3 months and carefully evaluate your positions. Otherwise, keep yourself away from the market. The constant presence of market in your environment invariably dilutes irrationality. I've come across so many people who have come to me with their tales of failure, and I can say they're largely because they have become overly active and they succumb to all kinds of pressures and influences in the environment in which they live. Strive to earn market return. You have to be satisfied with what the market can deliver in the long run, whether it is 11%, 12%, 13%, or whatever. Don't try to overreach and say, I will earn 20%. You may hear some successful investor having earned 20, 25%, but don't be guided by those things. Periodically rebalance your portfolio. If I have to give just 3 lessons to those who want to discipline their investment management process and mitigate the influence of biases, focus on asset allocation or stock bond mix, and this should be determined by risk tolerance and time horizon. If a person has a very high tolerance for risk, which means the person can endure volatility without being perturbed, and has a very long horizon, he is looking for an investment goal which is 15, 20, 25 years, he can remain fully invested in equities because equities in the long run provide a superior return compared to bonds. On the other hand, if a person has a low tolerance for risk and has a short-term goal, then his exposure to equity should be nil. This is a cell where
a person has a moderate tolerance of risk and medium time horizon. I call it as a 50-50 sale. If you are not sure where you belong, this is a kind of a default option. Yes? Can I? Diversification, as I said, diversification is only free lunch in finance and economics, and empirical evidence suggests that if you have a diversified portfolio of 15 stocks or so, you would have washed away most of the unique risk. You're left only with market risk, which by its very nature cannot be eliminated. Do not forecast stock prices. I have come across scores of, or even hundreds of forecasters in the last 50 years of my interaction with people in the investment world. I divide them into three categories: those who don't know, those who do not know that they don't know, those who know that they do not know but pretend that they know. Unfortunately, most of the forecasters who come on TV belong to the third category. In their heart of heart, they know that they do not know, but they pretend that they know, because when they're asked a question, they have to give an impression about their authority, about their professional competence, and their ability to see the future. Periodically review and rebalance. If you have started with an initial stock and bond position of 50 lakhs, if stocks go up to 80 lakhs and bonds remain at 50 lakhs, you can rebalance it in this manner. People rarely do it because at this juncture they are carried away by greed. If the stocks fall in the subsequent quarter to 50, then they have to sell some bonds and rebalance because their target mix is 50-50. But very few people do that because they're either driven by greed or fear, two very, very corrosive emotions. There's a very fascinating book called Mastering the Market Cycle by Howard Marks for those who want to improve the odds of their investing. Another book that I recommend is a book by Daniel Goleman on emotional intelligence. Essentially, by following a set of rules, by invoking the reflective mind, you become emotionally more intelligent. Daniel Goleman is an international authority in this field, and I found that people who succeed in various fields of finance are people who have high emotional intelligence. They're able to identify their emotions as well as those of others. Self-awareness, self-regulation, motivation, empathy, social skills. I have a very interesting picture here. Look at this diagram. Here, the stock market is considered to be a very volatile and turbulent environment. And in this diagram, you find that Vishnu is lying on a serpent. He is quiet, serene, composed, unruffled. The turbulence of the sea does not bother him, and Vishnu is served very faithfully by Lakshmi. Lakshmi, the goddess of wealth, is supposed to be very fickle, as we say in North India. Lakshmi बहुत चंचल होती है, but in this picture you find that Lakshmi is steadfastly serving Vishnu because Vishnu displays the highest order of IQ and emotional intelligence, and wealth is attracted and retained by people who have this combination. Key implications of behavioral finance: you need to improve the decision-making process. We won't learn from our mistakes. The thrust should be on improving the decision-making process. You have to promote discussion of uncertainties, combine inside view with outside view. The inside view of a project is based on the details which are specific to the project. We are often guided by the inside view. The inside view is vivid, visceral, intuitive, natural. The outside view of a project relies on what happened to a population of similar project. It is bare, statistical, abstract, and rational. Rely on Premortem. There is a very interesting technique suggested by Gary Klein, an eminent psychologist. In many group decisions, I found that if the chairman of the group has a certain bias, people are unlikely to challenge the chairman, or if a certain decision has been presented, people are unlikely to challenge because human beings have a tendency to conform to others. They don't want to create a situation of disharmony. Uh, in order to encourage people to express their dissent freely, Premortem technique has been suggested by Gary Klein. Uh, we are all familiar with what is called post-mortem. After something has gone wrong, we try to analyze why it has gone wrong. Now, uh, reverse this. Before you take a decision, imagine that you have a crystal ball which shows what will be the outcome 5 years down the road, and you know for sure that the outcome is a disaster. Then you ask members of the group, what factors could have led to this disaster? In other words, you encourage people to challenge certainties, you encourage people to express dissent, because now you're encouraging them to find why something could have gone wrong. Pre-mortem is regarded as a very useful technique. I found many organizers in the US now using both pre-mortem and outside analysis as part of their decision-making process. Combine intuition with rational analysis and develop taxonomies of deals and prepare a checklist for each type of deal. So I'll close here, Professor, and then take whatever questions the audience may have. Is that fine?
Yes, fine.
Hello?
Fine. Thank you. Yes, yes, yes.
It's okay. Please.
I have we have with us our treasurer, Dr. Kiran Yadav. I will request him.
Good afternoon, sir. I think
Yes.
that was one of the most simple, clear way of explaining difference between the rational and the behavioral finance fields. I think that we have several past presidents of BMA in the forum today with us. And to start with the questions, I would request that first we begin with the past presidents. I think Mr. Nitin Bhagwat is here in the forum and he has a question. So may I request Mr. Nitin Bhagwat to please ask his question himself?
Yeah, I think my question is, I posted it on the group. Dr. Chandra, love to if you can share some examples where behavioral finance has been used in terms of public policy or to create change in the country,
Okay.
in India.
As I said, Thaler has been one of the founding fathers, and Thaler and Sons Casten have written a book called Nudge. Yeah, and that book is based on the work they have done. They have found that there are ways and means of nudging people to take decisions which are more rational. And in the US, a cell has been created in the president's office, which was headed by San Casten. And then they have created a similar cell in UK. The whole idea is to influence public policy in such a manner that behavioral biases are mitigated. I'll give you another example. In the US, when someone signs for 401, whatever, then, if you, at that time, if you commit yourself that every year, whenever you have a salary increment, automatically your saving will increase by the same proportion. So if you have signed it, then people out of inertia continue with a favorable policy. So there are so many examples, and the book that I recommend to those who want to know how behavioral sciences have been used in shaping public policy is a book called Nudge. You
Thank
don't
you.
take away the liberty and freedom of people, but you present choices in such a manner that they tend to choose something which is more rational for them. For
Thank you.
example, in a school, they have done this study. You have healthy food and junk food. If you place the healthy food at a certain eye level or whatever, people tend to consume that food. And they found that it has altered eating habits of school-going children. It has altered savings habits of corporate employees. And they are looking at it from the point of view of various policy decisions.
So there seems to be a common question which has been raised by many of the participants, which seems to suggest that given the situation of the pandemic right now, all the information and news is towards saying that the growth is stunted, the markets are drying up, and that the fact that there is less number of productivity that is actually coming out. But in contrast to that, the markets seem to be booming. They seem to have crossed the threshold, which even booming times found difficult to achieve. So, from a behavioral finance perspective, how would you like to throw some light on this
Yeah,
phenomena?
as I said, Robert Schiller wrote that book, Irrational Exuberance. you know, and by the way, he published this book in March 2000 when the market was at its peak in the US, and within a fortnight, the market collapsed. He was arguing, I've been following his writings and lectures from 1995. He was arguing the market had become irrationally exuberant, but the market has its own life. Now, if I look at the current situation, I find that several factors are at work, perhaps. You have trillions and trillions of dollars of liquidity floating in the global financial system. If you look at all asset classes, they have risen to high levels. And this is largely the effect of trillions of dollars of liquidity. Some say about 14 to 16 trillion dollars liquidity has been injected. And this tends to inflate asset prices. You find a sharp inflation in housing prices in the US, in stock prices in the US, and you have bond yields which are 2%, 1%. I have never seen this kind of a phenomenon in the last 50 years of my study of markets. And you have about 16 to 17 trillion dollars of debt, which has a negative interest, which is an unheard of phenomenon. So, and as far as now, the Indian market is fairly small in relation to global market, and you have seen that if you have an infusion of a few $billion, it tends to push up prices because availability of stocks in India is rather limited. Promoters on average hold about 50%. Those stocks are not available. So institutions have, maybe 20, 30%, and individuals have the balance. Now, by the way, Thaler and Robert Schiller have been arguing that people are guided by narratives. In fact, Richard Schiller has written a recent book called The Narrative Economics. He says people are, that's why I focused on the story bias or the narrative bias. And a narrative is created. Now, if I have to look at the narrative is low interest rates are here to prevail. In the US, government will pursue what is called the modern monetary theory. Whatever is required to support the economy, they will do that. So asset prices will continue to rule high. I'm concerned equally about the inflation of asset price in the US. But I'm talking about the narrative that is currently gripping the minds and hearts of people. And when you are convinced that there's a lot of liquidity, then you can always say, we will have a steep V-shaped recovery. Corporate profits will rise by 25%, 30%. You can always create an internally coherent narrative. And as long as the narrative is shared by a large number of people, the market sustains its buoyancy. When the narrative changes, the picture changes. We never know how long this narrative will continue and when the picture will change.
Right.
Professor, before we go ahead, if you can stop this the slide share, we will get a bigger picture.
You want me to stop the slideshows, eh?
Yeah.
I have a question, Kavita ji, in
Yes.
case. Yeah. Sir, although you stopped the screen right now, but what I was trying to read neurofinance as a spiritual finance.
No.
Because there are
It's
three
not
terms.
spiritual.
Because you use the word intuitive, and the three words which describe those conditions: instinct at a very low level, then intellect is at higher level, and intuitiveness at a soul level. So you are saying that external conditions are coming and being processed, but by the time you start investing, be away from everything and think as a spirit and a finance and invest. Sorry.
Yeah, that's a very interesting observation, but I'm sure neurofinance will look into that, because in neurofinance, they're looking at the working the human brain of people under various conditions. And I'm sure if they do neuroimaging of people like Warren Buffett, they will find that Warren Buffett is unruffled. He has very stable mind. In fact, Ray Dalio says that he does meditation twice a day, and there are many Americans who are now regular meditators, and they have found a very interesting correlation between those who practice meditation and those who succeed in the stock market. In India also, we have some eminent investors who claim that their investment success is due to the equanimity that they bring to their investment decision making, which stems from Vipassana or any other form of meditation. So
yeah, you supported that by posing the picture of Lord Vishnu, that if he is at calm,
yes,
he's unruffled by the condition. So that means you have to go beyond that physical and mental level and then take a decision of investing.
Absolutely.
Thank you so much.
Thank you.
Yeah, right. If sir, basically what I observed is that in your talk, that ultimately all financial decisions have to be rational, and the entire study of irrationality, or what we call as behavioral finance, is to try and understand how that behavior can be brought back into rationality. Is that the crux of behavioral finance, or is it beyond rationality?
No, behavioral finance essentially is trying to find ways and means of mitigating the errors that we are prone to. Okay. I gave you examples of how even very intelligent people have committed great blunders. So that is the thrust of behavioral finance. Essentially, they are saying that human behavior is influenced by several factors, and economists have a very stylized version of economic agent. And that has been the thrust of work for heuristics and biases approach. And now Kahneman and others are talking of noise, which is another source of error. Probably a separate session is required to discuss the nuances of those developments, but that has been the thrust of work there. So, and we have very positive contributions. As I said, I'm sure some of you would be interested in reading that book, Nudge. Okay.
Right. Anyone who has a question to ask, could you please go ahead, raise your hand and ask a question, or else I will get tempted to ask more questions.
Yeah.
Dr. Kiran,
can I ask a question?
Sure.
Please.
you told me about the trillions of dollars of liquidity floating worldwide. Now, this liquidity
Yes.
is not likely to disappear in a matter of 1 or 2 years.
Mhm.
And how do you see a confluence of liquidity, innovation, newer vistas resulting in the pricing pattern of the shares or stocks?
Honestly, I can't answer that question.
I see. Okay.
Can I
I'm
ask?
reminded of a story. I'm reminded of a story. Some time back, I was reading the quotations page of Economic Times. My wife is not interested in financial matters at all, but after so many years of marriage, she asked me a question. He said, "What are you doing?" I said, "I'm looking at the quotations page." She asked me a question. What do you think makes the market go up or come down? For almost 45 years, she never asked that question. She is singularly disinterested in financial matters. She had unlimited access to my wallet. All her financial problems were solved there, and all my financial problems began there. So I wanted to duck the question, but suddenly I realized here was a once in a lifetime opportunity of lecturing to my wife. So I studied my glasses in a truly professorial manner and said stock market is a very complicated market influenced by a multitude of factors such as trillions of dollars of liquidity, the general acceptance of modern monetary theory in the US, the trade war between China and Russia, the uncertainty surrounding pandemic, the fiscal distress faced by government of India, the exceptional results of TCS, so on and so forth. I wanted to continue because I couldn't let go that opportunity of lecturing to my wife. She cut me short and said, "If you don't know the answer, just say so." So, ladies and gentlemen, that's the state of my ignorance about what is likely to happen, but we all create stories to support a point of view. I often say we are not rational creatures, and I'm making a very important statement. We are not rational creatures. We are only rationalizing creatures. Now, a very interesting book by David Eagleman called The Human Brain says that 95% of the decisions are taken at the subconscious level. We are not aware of that. Most of the decisions are taken at the subconscious level. The rational mind only is an advocate for what you have decided at the subconscious level. Period. If Ratan Tata had decided to buy Chorus, his lieutenants will produce spreadsheets. In fact, I was doing a finance gurukul for Tata finance executives around that time. And when this transaction was now, I said, how could you ever justify this kind of evaluation? And I am sure, all of you are familiar with ACF valuation. If I change the growth rate from 9% to 10%, I get a substantially higher valuation. If I reduce the cost of capital from 12% to 11%, I get a substantially higher valuation. One can tweak these numbers. What are we doing? Once you know what the boss wants, you create a model which will support the decision of the boss, period. So let us not fool ourselves that we are rational creatures.
Right, sir. We have 8 minutes left, and I think there are many
I
questions.
wanted
But
to
I
ask
say
one question. Dr.
three hands up. So I think we'll go in the priority of the hand raising. So let's start with Shailesh Bhai, and we'll see how many more questions we can take, sir. Shailesh Bhai, over to you. You have to unmute Shailesh Bhai.
All right. Thank you. Thank you, Kiran Bhai. Professor Saab, what do you think is the influence of Mr. Penrose, who just won the Nobel Prize for Physics and talks about consciousness on investing? In exactly the same vein that you were talking about irrationality, How does consciousness affect investments?
That's a very, very difficult to answer question. You know, that's the hardest part of physics, I suppose, you know. And I often say, if you look at economics, beginning from Paul Samuelson, you know, Samuelson wrote his work, Foundations of Economic Analysis, 1947. And Samuelson was a mathematically oriented economist. And Samuelson, in a way, became physics envy. You know, he said in physics, you have three laws which explain 99% of phenomena. Can we not have similarly three laws in economics? And my own reflection is that in physics, you know, three laws may explain 99% of phenomena. In economics, 99 laws will explain only 3% of the phenomena. You know, let us understand that it's a very complex adaptive system, and I have no answer, but I am just saying how difficult it is when you are looking at a system where you know, and unfortunately, you know, atoms do not have emotions. Human beings have emotions, and that's where the whole difference lies. And these emotions can fluctuate so wildly. And we have seen the narrative created by Narendra Modi and the kind of support he has got, you know, and I'm sure most of his decisions are instinctive decisions. And he will have a parade of people who will congratulate him, support him, justify him. That is how we find the political process working. And
I think in today's business world, they say that first you got to visualize what you want to happen. Then you got to behave as though it's happened. It will automatically happen. So I think that is going in the same vein. And how does this actually fit in with the Premortem theory, sir?
I'm sorry, I'm not in a position to answer that question, because if you know what Einstein was trying to do, he wanted to create a unified theory. You know, for the last 30 years of his life, he was struggling because he did not initially accept Heisenberg's principle and quantum mechanics, because at the subatomic level, you have a different set of laws at work. And physics is grappling with that phenomenon of creating a unified theory. And that is where Shailesh, now if you believe that there is a consciousness, you know, that is the belief in many spiritual and religious traditions. You believe that there is consciousness. This is the ultimate force which drives everything. Now, I don't know how it will take, but if you know, when Francis Crick got his Nobel Prize, people thought that vitalism was banned forever. You know, now they have revived. So uh, uh, I am sure, you know, if you have followed some of the works, Deepak Chopra and others believe that the consciousness drives everything. Among physicists, a person who seems to be more sympathetic to that view is Mikio Kaku. He has written a very fascinating book called The Future of Humanity, and he is an eminent theoretical physicist who has done work on string theory. But you know, when you get to that, you know, in to consciousness, you will always have that debate, I suppose.
Right. Sir, there are 5 hands up, but I think we've got only 4 minutes, so let's try and do this quickly. And I hope these are easy questions for you know.
Yeah, may I ask this question, sir?
Yeah, please go ahead, Sangeeta ma'am.
Yeah, thank you so much for this wonderful talk, sir. I have a very simple question. I'm just trying to understand the domain. So we have seen a lot of different type of biases are there, which create a you know, disturbance in a rational way of decision making. So please explain how these biases are interconnected. Is there a possibility that if I'm suffering from bias X, the bias Y would be higher or lower degree of you know, that the other biases?
Unfortunately, you find very little evidence of that kind. In fact, people in the rational finance model say that these people talk about various biases. These biases are internally inconsistent, and you always come across a psychological finding. You know, at the same time you say market overreacts, at the same time you say market underreacts. So you will find a lot of conflicting views in this area, and there is no clear evidence about how 2 or 3 or 4 biases reinforce each other or cancel each other. For the time being, what they have been doing is to identify various biases. I am sure it will take another 20, 30 years for them to say these are biases which tend to go together, these are biases which tend to work against each other. Unfortunately, most of the findings of behavioral finance are based on experimental studies conducted by experimental psychologists. And they are not studies done with real people in real markets and real economy.
So in your opinion, if at all, these biases trigger each other or cancel out each other, which bias you think predominantly are stronger, cognitive or emotional?
I listed those mirrors. This is my judgment. Okay.
Ji.
As I said, they have identified nearly 195 or so biases. The more important ones that I have found are captured in that acronym mirrors. If I have to identify one single bias, I think it is a myopic loss aversion.
Okay. Thank you,
The
sir.
second one is overconfidence.
Okay. Thank you so much, sir.
Okay.
Right. Dr. Chandra, I think it's 6:30 now. I'm just wondering whether you could take a couple of questions, or maybe because I'm sure
please go ahead.
the number of. Okay, so Umar Farooq, would you like to quickly ask your question? Please keep it short and.
Thank you so much for the opportunity. Sir, thank you so much for a wonderful session. And my question is on with health insurance being one of the critical areas of concern for a lot of countries, how can we use the principles of behavioral finance to influence people for opting for health insurance, even for segment which probably can afford but has been abstaining from getting themselves an insurance coverage? So if you can shed something on that, that would be wonderful. Thank you, sir.
Drawing from the work in the area of nudge, if you can frame the options in such a way that options which are more desirable from the point of view of the people who are protected by insurance are given preference. For example, if you look at what has happened in various countries within Europe, let me give you an example. Organ donation. If you have to opt out of organ donation in some countries, so people out of inertia choose the box for organ donation. That is the default options. Define the default option in such a way that the default option is the most desirable option. But if the default option is not defined properly, people are likely to choose something which may be irrational. So a lot of, we need to employ behavioral scientists in doing all this. And that is one suggestion that came even from our current chief economic advisor. He has at some forum talked about using the principles of nudge in public policy formulation. We have to create a unit of behavioral scientists in the government which helps the government frame options in a more sensible manner.
Right. I think Mr. Snehal Johar, followed by Karun Sharma ji. Please go ahead quickly. Okay.
Yeah.
While Snehal.
Can I ask? Yeah,
Please.
Yeah. Yeah. Sir, Shailesh Bhai actually endorsed the same things, but the term which is actually very popular, which I was going to ask a question, does law of attraction play a role in improving finance by investment? Because he also spoke the same consciousness and aligning yourself with the gain. Your experience and opinion.
That is a view shared by many who were sold on that book called Secret.
Yes, yes.
But I don't find any scientific evidence in support of that.
How about your own experience?
The way you have. Yes, sir.
I say, how about your own experience in investment?
Now, now here again, I find that some people are wired in a certain way, some people are wired in a different way. And I find a very interesting work where the neuroscientists argue that some people have a button for religion and faith in their mind, So you will find them very deeply religious. For them, everything calls for worshipping, For example, my wife is a strong believer in religion, whatever. And, in India, you find that religion is very pervasive. So you find a lot of faith in Indians. In this environment, yes, it is natural for many people to swing in that direction. But there are some who challenge that rationality. If I have to give a very, very different spin on this, someone was asking me the other day, we in India pray so much, we are so deeply religious. China is a communistic country. China doesn't believe in organized religion, yet they have done wonders the last 3-4 decades, or whatever. How do you explain that? For a while, I thought I felt that I didn't have an answer, but I felt that the basic difference in India and between India and China is, or in China, work is worship. In India, worship is work. So,
correct. But the religion and spirituality are different, and that is why law of attraction is away from there. So maybe just remaining positive. If you're remaining positive, that is going to get.
Yes, you have to maintain a positive outlook, and that is why I say if you take a long-term view on the market, you will develop that positivity. Look at the long-term performance of the market. Don't look at short-term fluctuations. You look at short-term fluctuations, loss aversion will make you very, very myopic. Okay.
Correct.
So one has to maintain, when you are investing, you necessarily require a positive outlook, and the positive outlook is created when the problem is framed properly.
Right.
Thank you, sir.
Thank you, sir.
I think as we move on to the last question, moving on from the law of attraction to a very fundamental question that the BMA president wants to raise. I would request Kavita ma'am to raise it herself about behavioral finance on a global level. Kavita ma'am?
Actually, this question is of Chaya madam.
Okay.
She has posted, how do we justify the huge investment in defense budgets by almost every country while we have challenges such as poverty, hunger, and lack of education?
Human beings have tribal instincts. Let us look at our ancestors. We always lived in tribes. We wanted to protect our territory. A nation is a tribe on a larger scale, But I would like you to read a very fascinating book called The Enlightenment Now, a book which is excellent read by Steven Pinker, Enlightenment Now. And in that book, he has looked at scientific evidence in the last few 100 years, and he comes to the conclusion that over a period of time, mankind has become more and more enlightened. And we have seen in our lifetime, we have seen the last 30, 40, 50 years, how much of enlightenment has happened. Since we have such unrealistic expectations, we don't appreciate many of the changes that have taken place. I'm sure if all of us were born before independence, our lives would have been very different. You live in a liberal democracy, which gives you so much of freedom to do what you want to. And I just tell people, just appreciate what Constitution of India has given to you, and you will realize the kind of improvement or betterment we have seen in this country, and the empowerment of women over a period of time. So coming back to your point, I'm sure there will be a realization, and this takes time. If you go back on the time axis, you find that Europe had so many warring nations. Most of their energies were frittered away in warring between China and Germany, between France and Germany, France and UK. There were tens of wars kind of thing over a period of time. Now they're living in harmony. We will gradually, it is like 2 steps forward, 1 step backward. I'm sure there will be a more reasonable leader in China in the years to come. Or the present leader may have some change in heart.
Right.
But I am very optimistic about that.
Thank you. It was one of the most enjoyable finance masterclass classes I have attended in last 40 years. We did our MBA by studying your books. We taught MBA students with your books. It was an honor and a sheer joy to listen to you in person. Thank you, sir.
Sir,
Thank you so much.
would it be possible to take one last question, because there's only one hand up now, Mr. Bigyan
Please,
Verma.
please.
Mr.
Yeah.
Bigyan Verma, please go ahead.
Good evening, sir. Good evening, Dr. Prasanna. In fact, what Chaya mentioned, she is so right. I listened to your talk as if I'm reading your book many, many years back. And even when I taught, obviously, time and again, I used to just pick up Prasanna Chandra's book in financial management. So I have a question. Both Tyler, of course, spoke about nudge, but Daniel also spoke and compared nudge and noise both. So do you see instances of nudge and noise playing a predominant role in the Indian capital market per se, and compare the US market?
Now, yeah, excellent question. Now that noise is being recognized as one of the sources of error. In fact, the claim of Daniel Kahneman is noise is perhaps a greater source of error than heuristics and biases. And he is doing work with some organization in the US to reduce the level of noise. Basically, it boils down to instituting a sound process, having discipline to follow a set of rules, making every important decision a multi-person decision. These are very specific things. So if you, over a period of time, and I find that many American organizations have become far more rational. In fact, there was a survey done some time back, and 800 CEOs in the US said their number one priority is to de-bias their corporation. That's a huge appreciation of the contribution of behavioral finance. Number one priority is to de-bias the corporation. I'm sure all of you have had experiences of decision making at various levels in the organization. And you will find that biases are so pervasive, they are subtle, they are overt, and you need to institute sound processes. If again, I have to talk about debiasing in corporation, I would say use both outside approach and inside approach, and use Premortem. You have a variety of techniques developed by behavior scientists, but these are two techniques which I strongly feel will considerably improve decision-making process.
Thank you, sir. Thank you so much. I think taking away from the law of attraction, moving towards enlightenment and realization by nudging ourselves to reduce noise. I think you've taken us through a long journey of financial behavioral aspects. And I think there are many books and topics that you've given us to study further. I think that's I'm just remembering my 30 years ago finance class, when at the end of the lecture the professor would leave more homework than the session that was attended. And I think we humbly feel that that's the same sort of feeling I think most of us are left with today. So thank you so much, Dr. Prasanna Chandra, for enlightening us on what real behavioral finance is leaning towards, giving us your valuable time. And I thank all the past presidents of BMA, all the office bearers. There are several students who are attending this. I think they will all go very much more motivated back to look deeper into the behavioral aspects of finance. And I'm sure that at the end of the day, we'll all have tremendously benefited from your talk today, sir. Thank you so much for the masterclass today. And I hand it over to the president of BMA to close the session for today, ma'am.
Yeah, thank you, Kiran sir. And Dr. Prasanna Chandra, thank you very much. I am tempted to take 2 minutes more. I will request our past president Indrapal ji to give the last comments, and then we'll stop.
We never imagined, Professor Chandra, that there will be so much in this session. I think you have completely added a new dimension to our understanding of finance. I mean, maybe we are outdated, but I think this whole aspect of behavioral finance, how it could impact lives and change them, especially at policy making level if it were followed, is the most important contribution in my view you have made. I'm sure you would be functioning on various government bodies to share your perspective as to how important the work of nudge and other theories are, and to frame policies which are not wasteful. We have resource crunch, so we don't have to waste our monies. And therefore, this whole orientation of behavioral finance could make really wonders in our country. So thank you very much. I mean, apart from being a retail investor, we can benefit by being like Vishnu-like. That's a different thing. But we want Lakshmi to press our legs and all that. That's fine. But still, this whole making lives better is such an important dimension, which is being missed out in so-called rationality, which is heavily biased. So removing biases and using our huge budget in a more productive way, I'm sure would be our priority number one in the country. So thank you so much, sir. We look forward to you maybe some later date again to have you for speaking on the topics that you have touched upon. We loved your stories. We loved the overall narrative. And I think truly you are an outstanding professor. Thank you so much.
So thank you very much. And I acknowledge presence of our past presidents. Indrapal ji definitely is here. Fernandez sir was here for, he is there, I think. Tendulkar sir is present, Professor Mani, Chaya madam, Nitin Bhagwat sir, and many of colleagues from academia, Dr. Sen Gupta from Higher Education Forum, Dr. Srivastav, Professor Majumdar, Praful Pofre, I could see Faki sir, Anita Shanbag, Sangeeta Pandit, and many more of my colleagues from various institutions and students who have been here. And very happy that the first episode of our masterclass has gone really very well with so many insights, and realize that Professor, you have given us so many researchers who have worked, and their significance and their relevance to the topic that you have come up with. Thank you so much. And my colleagues from EC also are there. So today we close with a very great feeling that we have heard you, and now the books will more be important to us, because now we can relate to your speech also with the books. So thank you so much. Let me remind all of you, on 11th we have Gaurang Das Prabhuji, and on 18th we have Kevin Keller's masterclass. So join us for these masterclasses. Wednesday Wisdom webinars, Friday Fundamentals, and the summits and conclaves that we make in BMA for more interesting, more relevant, and very contemporary topics. Do join us. Thank you very much. Stay home, stay safe, and let us meet on Friday evening once again at 5:30. Thank you so much. And thank you, Professor Chandra, for giving your time. Thanks. So we close
Thank
here
you.
for the day.
Wonderful, wonderful evening. Thank you, Kavita ji. This was fabulous. Professor, what a delight to listen to you. Absolutely fabulous. Bye-bye.
Now,
Bye.
I think the next session will be only open to all those who have read all the books that you suggested.
That will be a big imposition, eh?
At least those who have bought all the books should attend.